Mind your P's and Q's, everyone. We're recording now. All right. Well, let's get this started. Good afternoon, everyone, and welcome. Thank you for taking the time of your day to join us. We really appreciate you being here. Our goal here today is simply to help you better understand condos and financing and the process and avoid surprises, and protect your clients and close more transactions. But before we get started, let me see a quick show of hands. Who's had a transaction where it's either was difficult to close or didn't close because of the HOA or situations with the HOA, and you were pulling, or you closed it by the skin of your teeth, and you were, pulling your hair through the whole transaction, and maybe certain headaches could have been avoided had more pertinent information been obtained up front. I did.
Jeffrey's like doing the life like he's like, yes, yes, yes.
Well, we're right now in a transaction with Jeffrey, right? And we're going to touch on that as well. That we're closing very soon, but that one also has a story of its own, right? Based on the circumstances with the
It was
financing. But
declined. It was declined, like flat out
well,
declined.
it was declined. Yes, initially it
Hmm.
was declined, right? And so obviously you can see you're not alone. So this is the reason why we put this presentation together. And, I think it's something that we should continue to educate our realtors on, because it ultimately does make a difference.
Absolutely. And we're going to talk about the challenges, but we also want to like focus in on the opportunity as well, because these challenges are leading to opportunities for many. And I'll make a comparison for you guys later on to other market conditions where we've seen this in the past. So I believe the condo market has real opportunity if you have the stomach for it.
Oh, I agree. It's real opportunity. And actually, we have a couple of transactions right now with such an opportunity for these individual clients that are stepping into a substantial amount of equity simply because of the challenges that are occurring. And because of that, it's hard to sell a condo. No, we read this article, right, where it's starting to sell a condo at max price right now because of the financing available or the challenges with the HOA and such and so forth.
And we're not just going to go over the current challenges, but we're going to go over changes that literally were posted on Fannie and Freddie a week ago. So a big upcoming change, big one. And then that's what's going to happen at the beginning, those that are going to happen at the beginning of 2027. So this is a right now conversation, and this is a definitely pay attention if you are listing or selling anything at the beginning of 2027. And we'll go over those dates with you guys in the presentation.
Perfect. Does everybody see the screen here?
Yes.
Okay, got
Yep.
it. So, and just full disclosure, I did take a lot of notes here. So if I'm looking down, I'm referencing my notes, but really the intention here is to get as much information to you guys as quickly and sufficient as possible. I don't want to get off of the Zoom right here and look at the presentation again and say, oh my God, I should have said this on this. I was thinking it beforehand, and in the process of the presentation, I just kind of slipped my mind. All right.
And a request, if you just put your questions in the chat, we're going to address all of the questions at the end, okay? And
Okay.
just to be mindful of everyone's time.
So let's start with this slide. So the big idea. So a condo loan is really three approvals in one transaction. Okay. The first, you have the borrower, the pre-qualification, the borrower qualify income, assets, FICO score, etc. Then you have the unit, the type of transaction, whether it's an appraisal, you have to deal with appraisal, the occupancy, title, legal. The first two apply to single family residence, right? Now, if you're buying a single family residence, that's it. Those are the two things you have to actually qualify on. But with an HOA, there's that third component, which is the project slash or the HOA. And now you introduce insurance, budgets, reserves, repairs, litigation, anything that involves that particular HOA. Maybe delinquencies on the HOA dues, maybe a situation of how many units are owner versus non-owner, or so on and so forth. So the perfect borrower plus the perfect problem, HOA equals a possible loan denial. And we saw that, like we mentioned on earlier right now on Jeffrey's transaction with one individual bank, we got it down. But it wasn't because of the borrower, it was because of the HOA and the complex itself.
And I'm just going to say right there, if you're representing a buyer and or representing a seller in a condo situation, to give yourself wiggle room, it's explaining that it's a three-part process. That's why we want everybody, including buyers, to understand this is a three-part process. So while you may be perfect, it doesn't mean any bank is going to do the loan.
Correct. So Go ahead, Kim, you want to do that? Or what we're
Yes.
covering? Go ahead.
So what we're going to cover today is first the language, just making sure that you all understand the difference between condo, PUDs, the different types of properties, and warrantable versus non-warrantable. We're going to talk about the red flags. This is the big one. If you're going to take away anything from this, it's got to be the red flags, okay? Because they're red and they're screaming at you. We want you to be able to identify them. The documents, what to ask for up front. In the situation that we had with Jeffrey, he did. He did the homework. And then the listing agent didn't have what was necessary, and through no fault of hers, just happened to be that they sold the same property a few months ago. So things change, right? Just because the condo was great 2 months ago doesn't mean that the complex is great today. We're going to talk about your program options, all the different ways we finance them, the deal challenges, and how we save them. And then if you're a realtor, we're going to talk about a playbook for you, because I think that this is really an opportunity to start pitching yourself as a condo expert. And we'll explain more why that I think that there's a lot of benefit for a realtor who chooses to do that, very much akin to like somebody who specializes in probates, a real way to distinguish yourself. So our goal is to avoid surprises, protect your timelines, and create more ways to close when standard financing says no and doesn't allow you to.
Well said, Kim. And yeah, our goal is to make you guys lenders is more to understand what questions to ask and what red flags to look for. So first, not every condo looking like property is the same, right? So we have condominiums, which are your standard buyer owns the unit plus the undivided interest in the common areas. Then you have what is called a PUD or a townhouse. Typically, that's attached to another building, or it's attached or unattached, I should say, to another building. And that one can tend to be treated differently if all four walls don't touch another particular unit. Then you have what you call site condos. These look like detached single-family properties, but legally as a condo can be easier and still verify program rules, right? Then we talk about condo hotels. They're hotel-like operations, front desk, transient rentals, or mandatory rental pools are usually a major red flag on these. Co-ops, we see these a lot in like the city of Long Beach, downtown Long Beach, where buyer owns the shares, not the real property in the same way you would like the wall space, right? And financing and approvals are very specific for this. And the next one is new converted phasing pre-sale control transfer. So new converted is something like, for example, it was an apartment building and now it's a condominium complex. And those are also tend to be treated differently with financing the way it's concerned. So we start with the legal description of the project first, not what is listed on the MLS. So if it says condo on MLS, take it with a grain of salt, look at the legal description, look up title, and that's exactly the most important aspect of where you start with. You're looking at determining what type of financing is one of these particular properties will qualify for.
And so I just don't want to presume anybody where they're at in their career in terms of understanding. So I want to break it down to you simply. A condominium, you own the airspace. The air in between the four walls is what you actually own. So you will own an undivided interest, a very small percentage of the building, but in theory, it's the airspace. That's it. You don't own the dirt underneath you. In a PUD or a townhouse, you do own the dirt underneath you. And the big distinguishing factor here is PUDs and townhomes price out and are treated like single family residents. Okay, so that's a big
All
distinction,
right,
and
thank
you'll
you.
find out later why, in terms of interest rates. And how do you know? Look up the address, and if you say the words an undivided interest of 1/100th, 1/110th, 1/116th, whatever. If you see a fractional percentage interest, it's a condominium. If you see lot 7 of track 2345, if you see it like that, that's a PUD or a townhouse. So we recently had an experience with the realtor who was chasing his tail on condo docs, and his listing was actually a townhouse, a PUD. And it's a big, big difference. Doesn't mean that some of the rules we talk about won't apply to them. But again, a big difference, much more marketability, primarily conventional versus FHA. That's where you're going to find the real distinguishing between condo and townhouse, and also a site condo. The remaining three, condotel, co-op, or the newly converted, you're not going to see those as frequently, and financing is going to be a lot more challenging. So if you're looking at a listing and you have a client who has an interest, or if you're a buyer and you're looking at a Zillow listing, you want to determine the legal description ASAP because it's going to impact the type of financing that you get.
Exactly. And just moving on to the next one, I think we're clear on this one. The
Mhm.
next concept is probably the most important financing term you're going to hear when it comes to condos. And Kim?
So warrantable versus non-warrantable. This is the biggie. And you might hear about this. If you haven't heard about this, what's the easiest way to distinguish it if you're looking in Zillow, looking in Redfin, looking in the MLS? The minute you start seeing words like cash only buyers, right? That's what'll trigger your eye. The distinction between the two is a warrantable meets agency project standards, either through Fannie Mae or FHA. What does that mean? That means those entities are going to insure these loans. So they're typically eligible for standard conventional options and FHA. Across the board, they're going to price better, and we're going to have many more options for lenders of where we can send that to. And you're going to have your lowest down payment options available. That's under warrantable. Where we find a huge majority of condominiums today is in the non-warrantable category. They do not meet agency project standards. And there are standards, doesn't matter who's doing the loan, these guidelines are in place. So a non-warrantable doesn't meet them. We need either portfolio or non-QM financing. What is that? That's financing that a bank is offering where they're not subject to Fannie Mae, Freddie Mac, or FHA guidelines. Basically, they're writing their own rules. And inside of writing their own rules, they get to decide, do we want to do these types of loans or not? So these are not traditional conventional loans. And you will never get a non-warrantable condo ever under Fannie Mae or FHA or Freddie Mac guidelines. They do offer higher rates, not super high. They can be a lot higher for lower FICO borrowers for sure. They're going to require more down payment, probably require more reserves from the borrower, and no two investors look the same. If we go to bank A, they're going to have their set of requirements. We go to bank B, they're going to have their set of requirements. We go to bank C, they're going to have their requirements. What's interesting and non-warrantable is if the bank didn't think about it, if they did not write a guideline around it, they automatically defer to Fannie Mae. So you could almost look at it like I have ease, but then I also have to be concerned about a possible restriction in the background, those things that affect the borrower. So this is where, as a lending team, JR and our expertise really matter because it's having the conversations up front when we're entering the transaction, not knowing, are we going to be warrantable or we're not going to be non-warrantable. But a big heads up, if you have a buyer putting less than 20% down, you should absolutely know. And I personally would not be opening up an escrow or sending out an EMD if I didn't have the answers to the questions that we're going to show you guys in this meeting.
And the reason Kim mentioned 20% down, because with the non-QM portfolio type of programs, if your borrower's coming with 3 or 5% down on conventional, they don't offer 3 or 5% down conventional financing. So you need sometimes a minimum of 20% down, maybe 10, 15, depending on the program and the borrower strength, but typically about 20% down. So at least with the 20% down borrower, like in Jeffrey's case, we have options to move them to a non-QM portfolio lender.
And think about it this way, the investor, the bank funding this, they want you to have some skin in the game. Like it's a shared risk, right? Inside of the
Mm.
financing. You put 3% down. I mean, that might be a lot for a lot of people, but most people can walk from 3% down. Not too many people are going to walk away from 20% down.
100%. And so at the bottom, very important, non-warrantable does not always mean impossible. It means strategy matters. Okay. How the condo project review works. So first, we must identify the project, the legal project name, address. That's why a lot of times we ask you, what is the HOA? And not just what the HOA is, what is the name of the complex? So the complex name can have a different name than what the HOA is. Then we collect docs, the questionnaire, the budget, the master insurance, litigation letter, reserve studies, and meeting minutes if needed. So this is something that's done up front on a condo. Third, we choose the path depending on what we find. Waiver, extent review. For example, are we going agency? When we say agency, we're talking about traditional conventional Freddie Mac or Fannie Mae or FHA, VA, or are we looking at the portfolio non-QM process? And number four, at that point, we submit the file depending on which lender, which path we choose, and we clear conditions with the underwriter. And the way this is very important is because in a situation where all this information is not gathered up front, we can't just assume that the complex is going to have any issues up front. How would we know that? We have to go in there and give the borrower the best financing possible, because the borrower is looking for the best terms possible, and traditional conventional is always going to give you that. But when we find out that this condo isn't financeable with any lender under Fannie Mae or Freddie Mac conventional financing, for example, then we have to pivot to another investor, which is a portfolio type of private investor. And so what happens with that is that we've already burned like 15, 20 days up front on the escrow, trying to get the borrower the best financing options, where we can have an opportunity to have that conversation up front and eliminate those 15, 20 days and just go straight to the portfolio investor, knowing that this particular condo project or condo complex isn't going to get financing.
That's exactly correct. And here's the big thing. None of this information is free. Okay. HOAs that don't provide this information free. Somebody is paying for it, either the seller, the borrower, where they're in the transaction.
Mm-hmm.
But a listing agent listing a condominium today without knowing this information, and a selling agent writing up an offer, or a buyer being represented by an agent writing up an offer on a condo in the absence of this information, is an extraordinary disservice to the borrower, and quite frankly an extraordinary disservice to the seller as well. Because once you're in escrow, especially in a market that we find ourselves like in today, once you're in escrow, nobody's going into escrow thinking we're not crossing the finish line, right? People are hiring movers, they're making plans. Everybody's making plans. And you're 15 days into this. We offered a 7-day loan approval, 7-day appraisal, and you're in your inspection periods, and then all these things start coming out. And guys, this is so avoidable. But if you're representing a buyer, you have to be annoying and pushy. Like, you can't just, condos today aren't the be grateful they accepted your offer conversation. Condos today are the sellers like, be grateful I sold the property. So you really have to be assertive in your request and really not take no for an answer unless you're down for doing 2 transactions or dealing with everybody's emotions in the transactions. It is that critical. So if you take nothing else away from this, you're going to remember that if I'm representing a buyer, I'm absolutely getting as many of the answers to this question as I can. And if I'm representing a seller, I'm making a full request for every single document that HOA has available today. That's how you shine and become an expert in the condo market that we're talking about, like in real time right now.
I would even go as far as to try and enroll the seller on paying for that questionnaire up front when you're selling the
Absolutely.
property.
And we'll talk
Because
about what that is in the
yes,
coming slides. So, the common financing paths on condo projects. As we said, agency conventional, that's Fannie Mae. You'll hear about it, Freddie Mac, just the standard conventional, right? FHA, a little bit different. Right now, about 1 in 15 condominiums are FHA approved. And there's 2 ways to have that approval. There's something called the spot approval, which we'll go over briefly, and then it's already approved. Here's the irony, and this is why I think there's so much opportunity. It's rare to find a condo complex approved in 2026 where their current approval still exists. Either somebody did the work in the early part of this year, meeting all of the now legal building safety standards, but the majority of them are not. You see the expirations in 2024, 2025, some is 2023. So a lot of them that were approved as FHA no longer are. And we recently had a transaction, an agent who his seller has an FHA loan. So he automatically assumed the condo complex was FHA approved with zero question, just total assumption. advertised it as FHA, had a buyer as FHA, and then not only was it not FHA approved, it couldn't even get conventional financing because of the reason that we're going to show you. So the moral of the story is you reach out to us and ask, and we will confirm with you with our access that it's FHA approved. In the absence of confirmation, you're probably wasting your time. And there's specific rules on spot approvals that we're going to go over. So it's not a give me. It's not like conventional. And conventional now condos are listed on Fannie Mae's website. So if they're blacklisted there, you're also not moving forward on this. So as a listing agent and as a buyer's agent or as a buyer in a transaction, not asking these questions and not being 100% sure are going to cost you a grip of money during the transaction. VA is another animal. A lot of people think that just because it's FHA approved, it's VA approved. Wrong and not at all true. Nothing could be further from the truth. And VA has its own specific requirements. So think about it, if you put a VA buyer into a condo with 100% financing, extraordinary financing, you can't even get, like, if that's conventional, the financing is so much uglier if you're coming in with 3% down than a VA buyer coming in with 100% down. But without knowing if it's approved, you're not likely to convert that borrower into another type of financing because they're coming in with no money down. So when showing a veteran condominiums, there's a lot of back homework to do before you actually write that offer up and or let a listing agent accept your offer. There's a lot of newer realtors in the industry today, and we've experienced the painful way all of the lack of training in the condo area. So I want to acknowledge those of you who are realtors for being on here for
Yeah.
that, but it's a big task. It's not something that you should take lightly. And then non-QM alternative specialty financing. JR and I have saved some from our current clients and some from clients who were brought to us. I think like 11 transactions this year where they all started conventional and all ended up closing non-QM. So I 100% consider myself an expert in this arena, and JR and I are experts in this arena, quite frankly, which is why you should be working with us, only us. But the preferred loan product may not be the product that we close in. And we keep mentioning Jeffrey's client, but it's a really relevant conversation because the client was coming in with 20% down, not 50, not 6, 20% down, standard 20% down, 804 FICO, kind of the guy who's going to get the best pricing out there, right? Condo complex doesn't pass Fannie guidelines. So we started him on an ARM, had to flip into a 30-year fix with an interest rate of 0.5% higher. And we'll explain to you in a bit why he went for that. But that was the difference in the financing. So the borrower saw the opportunity and went for it. But if there was an opportunity inside of the value of the purchase, he probably wouldn't have gone for it. And that's where realtors end up being disappointed. That's where sellers get extremely upset. So I think you can get the whole nuance of this webinar so far is preparation, 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 preparation. That's how we all shine in this transaction, and we shine with our clients.
Yep. So now that we know condo financing depends on the project, let's talk about the biggest challenge affecting California condo associations today. The SB 326 report. Now, this law has become one of the most important topics in condo transactions today. And so why was the SB 326, why was it implemented? Well, it was simply a tragedy that changed California law. In 2015, a fifth floor balcony at Berkeley, California, up at Berkeley, Cal State Berkeley, collapsed during a gathering, resulting in the death of 6 students and injuring 7 others. So what transpired from there, the investigators found extensive hidden dry rot and water intrusion, weakening the wood structure on the balcony until it failed. And so the tragedy highlighted the need for routine inspections and aging exterior structures in condominium communities. So the SB 326 was created to improve resident safety, detect hidden structural deterioration, encourage preventative maintenance, and reduce the risk of catastrophic structural failures like this one. The SB 326 was not created because of the 2021 Surfside, Florida condominium collapse. That's where the entire building collapsed, or half of the building collapsed. California enacted the 326 2 years earlier in response to the 2015 Berkeley balcony tragedies. But right now, we're going to show you why you're barely hearing about it now and not back in 2019.
And that's because January 1st is when Fannie Mae
Right here.
really started implementing it. So the SB 326, first we're talking about specific types of structures, right? And the types of structures that we're talking about have, and this is to exterior, not interior. So a lot of the times when you're showing a property or you're looking at a property, if you're a buyer, this is the clue in, right? The structure has to be generally sound, the exterior. If it's more than 6 feet above the ground, it applies. If there's supported substantially by wood or wood-based products. So if you see a stairway where the railing is cement or metal, but the steps themselves are wood, that would apply. Anything that's designed for people to walk on, stand on, or occupy, balconies, decks, catwalks, those are stairs. Those are red flags. They should be automatic red flags. How does this look? Does it look like the termites are holding hands together, and if they let go, the whole building is going to fall down? We just funded one of those like literally 3 days ago, where that was exactly the case. It did look like it was going to fall down. And so the timeline on these is in 2019, SB 326 was signed into law. It became effective in January 1st, 2020. In January 1st, 2025, which was last year, that's when the first initial inspection deadline is imposed. That's why everybody is experiencing the pain this year.
Mm-hmm.
And every year there forward, or excuse me, every 9 years there forward, you have to renew or redo the engineering report and address the same repairs. And this is exactly where we see all the problems, folks. January 1st, 2025, the initial inspection deadline, not work completed, inspection deadline. Do you know how many HOAs literally waited until December? I think the last three reports we've gotten were they were all dated December 1st or December 15th or December 30th in 2024 because they had to. If you're an HOA, the state of California holds you accountable, so they had to be done. But think about it. If you have 200 units and the primary exterior component is wood, and you just got the inspection back in December of 2024, have you fixed anything? Have you disclosed to the owners? Have you done anything? The answer is a big fat no. Ongoingly, we're finding out that most of them have not. And so you could start to ask yourselves question. You see wood outside, you see balconies that are not 100% concrete, any measure like that, or something that looks unsafe, that is a red flag, not just in your negotiation, but it's like, am I going to actually cross the finish line and getting this financed? Those are the questions you should be asking yourself.
Yep. So just remember this, guys, the three E's: exterior, outside, elevated above the ground, at least 6 feet, and elements being wood. What is it made of, or what is supported? In this case, you see wood here on the beams, and you see the stairs right there attached to the wood. Well, these might be concrete and might be metal. If it's attached to the wood, at that point, it falls under the SB 326 inspection guideline. So remember the three E's: elevated. So because if it's a walkway and it's on the ground level and it deteriorates, no one's falling off of it, right? And if you do fall off of it, you're going to get a scratch and maybe that's it. So it doesn't really pose a danger, and that's not a requirement at that point. Now,
And I want to say something. Oh, sorry. Go ahead, Jer.
I say one more side note. For condominiums, the required re-inspections every 9 years. But for you commercial realtors out there, or have a borrower looking for an apartment complex or own the apartment block complex, it's every 6 year for apartments, the re-inspection. Just so you guys know.
Exactly. So if you own an investment or selling an investment, they're subject to the same thing. This is not a condominium specific. It is a building and safety specific guideline. And speaking to what JR said, if you see it on the floor, don't necessarily think nothing about it, because depending on the investor you're going to, even though Fannie may not require it, at the end of the day, the underwriter has they have the last word. We had a client who just the whole complex was denied by Chase. And it was within the reach of meeting Fannie Mae guidelines, but nobody wanted to risk it. They're like, they don't want the loan. So you cannot force a bank to do the financing. Ultimately, it has an underwriter and it's the underwriter's call. So if you think it looks funky or like hey, health and safety, call it out. Either call it out as a buyer, if you're the listing agent, call it out to your seller to address their HOA, but call it out. Don't ignore it because ignoring those little red flags are what end up to being huge headaches in the long run for everybody.
Yep, and this is what I'm going to
And
go through it
what
quickly.
could I ask? What happened on January 2025?
We'll do these questions at the end, hun.
Okay.
Oh, that's when the first 2025 initial inspection deadline for the SB 326, the first one.
Which means
So,
HOAs had to have already had the engineering report on all of their exterior
Right here.
elements that fall under this guideline. They had to have that initial inspection done by January 1st, 2025.
okay, got it.
And there's just a clear picture of what structures are covered, wood frame balconies, wood frame decks, elevated walkways, exterior stairways, and landings. Okay, so remember again, the three E's: exterior, elevated, in this place, wood, element being wood, and people. If it supports people, it needs to be inspected with all the other elements there.
Correct. And it should be, honestly.
Yep.
So what is generally not covered? Typically, the structures that are not supported substantially by wood, such as reinforced concrete balconies, ground sidewalks, ground patios, interior hallways, steel supported balconies, masonry supported balconies, are not subject to SB 326 inspection requirements. However, if a balcony appears to be concrete but has wood structural components that provide substantial support, it may still fall under the law. Howard and I closed a transaction. He had concrete and wood mixed together, and the underwriter said this falls under the law. We got a quick report. It was handled. There was no health and safety, but we weren't closing without the report. And we discovered it at the end. So, again, if you see it, you should be asking yourself the question.
And why realtors should care. The inspection can affect the entire transaction. An SB 326 inspection may reveal deferred maintenance, safety hazards, require structural repairs, special assessments, HOA reserve delinquencies, insurance concerns, financial challenges, and escrow delays. Remember, this trickles in. You got to make the repairs. The money's got to come from somewhere, right? It can come from the budget. And the budget is under reserve now because they were allocating those to repair these. And now we're under what do you call it? We're under reserve. We have less than the 50% required reserve now to qualify for traditional type of financing. So it's like a chain event. And obviously, questions every realtor should ask: has the SB 326 inspection been completed? Are repairs recommended or required? The HOA knows that they're in the middle or are about to start or complete repairs. Is there a pending special assessment? Have the repairs already been completed? How could this impact financing? We're going to get more into what the assessments are or assessments can be. So the takeaway there: earlier you understand the property's SB 326 status, the better you can prepare your buyers, sellers, and lenders to avoid surprises and keeping the transaction on track.
And a real case scenario that literally we funded the loan on Monday. There's a project in Whittier, California called Workman Mill. You may not have heard of it. You may have sold in it. We had sold in it multiple times. We financed over the years. Our realtor sells the property. The property says all cash. They want all cash. They enroll the seller in going for our offer. They take the offer. Nobody asks any questions. Why did they take our buyer's offer? Because our buyer offered more than the all cash offer. That's why. That's the only reason why. So listing agent asks 0 questions. Selling agent asks 0 questions. And there was one of the balconies that had like those red ribbons that are like do not walk on it. So you got close to 300 to 400 units in this whole entire complex. It looks like you're in Big Bear. The entire exterior is wood. All of it. Not part of it, not a little bit of it, all of it. And a unit that's nowhere near our unit, like on the other side of the complex, but it has it's red tagged by the city. It's going to be one of the first ones that would have been like a stop dead in your tracks, right? We open up the escrow. The very first question I ask is, do you have an SB 326? Crickets. realtor listing agent has no idea. I tell my selling agent, they don't know what an SB 326 is. Our selling agent says, neither do I. What is it? And the HOA was so uncooperative. And this is one thing that we have been experiencing ongoingly is the lack of cooperation from HOAs. And I firmly believe for the amount of time I've been doing this is because HOAs are exacerbated by the amount of requests that are being made from them around all of this documentation on this health and safety. Some of these HOAs are run by many are run by management companies. Some are great, some not so great. You find out how great the HOA management company is when you're in this transaction. So it's one more reason to be insistent on whoever's responsible for delivering that in the transaction to get the reports and not just the SB 326, everything that surrounds health and safety, because you're going to find out one of the reasons you're no longer going to be able to get away with it if you don't know the answers.
Yep. So condo guideline changes you may need to know. So you need to know these are just coming to effect within the last year and currently have been coming into effect this year as well. So these are for Fannie and Freddie Mac, right? So these are positive in our opinion, positive changes. The first one is expanded small project waiver, which means that more than 2 to 10 unit condo projects may qualify without a full project review when eligibility requirements are met. So before, if you had less than 10 units, it was very difficult to get a approval on these condo projects.
A limited
right?
review.
A limited review. And 50% investor concentration limit eliminated. This is a huge one. What does this mean? So before, in order to get conventional financing on units for on a condo complex, and you're going to buy a condo, if investors, if more than 50% were non-owner occupied, you couldn't get financing. They had to be 50.01 owner occupied the units or more to get financing with Fannie or Freddie. That's no longer the case. They can all be non-owner occupied, and you can purchase one as an owner occupied transaction now under Freddie and Fannie Mae financing. That's a huge one. And inflation guard requirements removed. So this simplifies the condo project eligibility requirements. So this one is the Fannie Mae removed the insurance requirement, making it a little easier for project. So the comment, let me just see. Okay, these changes create more financing opportunity to condo buyers. No, never mind. Forget those notes. I had some other notes on there, but Kim, you want to add on anything on this one?
Yes, I do. I want to talk about the 50% investor concentration and why we think that's such a great change and why it might not make sense to you. So if anybody was around in the housing crash in 2008, condos were one of the types of properties that took a beating, right? I mean, everybody walked from properties. When you could get 100% financing and it was stated income, pre-2008, if you wanted to, what were you going to rent an apartment? You were going to do stated income. You're going to go buy yourself a condo, no money down, loved it, right? And then when the market crashed and everybody turned upside down, you came in with no money, values went down, you have no money, you have no equity. People walked from condos like with zero thought. So you had investors come in and do bulk sales. They would buy back in the day, I represented an investor who purchased, it was like a 40% unit. He purchased like 13 units, right? In a bulk sale. He got all of them. So when that's when this rule, this rule was already in place, but that's really when you saw the impact of it, because you did have investors buying blocks and blocks of condos in a building, which kind of turned it into apartment building. So if I'm a homeowner, like no judgment, but being judgmental, I'm not sure I want to live with like people who are just tenants, right? Homeowner takes care of a property one way, tenants one can argue don't take as great of a care of the unit. But when you have a shared interest, because that's what a condo is, you are sharing with many, many other owners, and more than 50% of them are tenants, you can see how that complex can go from being nice to not so nice, right? So what I see, how I see this based on how long I've been in the business is with all of the condo challenges we see today, I can see investors buying blocks of condos again. And now this requirement won't impact a regular buyer or a regular buyer who's an investor trying to do regular conventional financing. This won't impact them. They can go in and buy in there regardless and still have options for the better types of financing. So that's a big one. Some of you may not have been in the business long enough to like have experienced that, the downside of having a high investor concentration. And the great news is you no longer are going to. And I do see investors looking at condos in the next 24 months, specifically as investment opportunities. I for sure would. I 100% would, as an investor, be looking at condos right now and the opportunities in condos. So this may not make so much of a difference today, but I promise you 12 to 18 months from now, the loosening of that guideline is going to make one hell of a big difference.
Yep, perfect, Kim. And also, I found my notes, it's trying to read my writing, but on the inflation guard requirement removed, so you guys understand what that really means. It's not, we're not teaching you guidelines and how to qualify a client, but it's really just a Fannie Mae has removed the insurance requirement, making it a little easier for some condo projects to qualify. It's an insurance inflation guard.
And then the not so great news. Okay. And this is going to be the one that you guys probably never hear about, but is going to impact you the most. Effective this Monday, so it's already gone. So if you have a condo listing and you're in escrow, you definitely want to ask the question, who's ever doing the financing around the limited review being eliminated?
That's a 3 days
Okay,
ago.
this is a big one. There is a questionnaire when a client starts a transaction in condo financing. We, as the lender, make a request from the homeowners association to answer a set of questions. And if our clients were putting 20% down or more, and if they had high FICOs, because it was definitely tied to the FICO, and you were running an automated approval, which is required in all loans pretty much, even if they're non-warrantable, many banks still want you to run the DU. It would tell you this unit qualifies for a limited review. So instead of the HOA having to answer 30 very specific detail-oriented questions, they had to answer 5. That's it. And the 5 hit the big ones, litigation being the biggest one. That litigation is the biggest one. Why? Because if there's litigation against the HOA in certain areas, not all litigation, but if there's certain litigation, that could potentially impact the financing of it. But 9 times out of 10, you get a limited review and you're like, yes. It's like getting an appraisal waiver almost. You get an appraisal waiver and a limited review and you're like, let's dock this baby, right? Well, that's going away. So everybody is going to have to answer the long ass list now. Every HOA, no matter what. So I see the impact twofold. One, I promise you, HOA fees are going up on the questionnaire. I've seen HOA fees for buyers going into transactions right now increase about 30% this year, which is highly significant because you didn't see increases for like 5, 8 years. No increases at all. We already see them going up a substantial amount. Substantial. There's so many questions on the questionnaires. These are Fannie Mae standardized questionnaire. FHA has their own questionnaire form. They are not intrusive, but they are in as much as they want the HOA. They're asking every potential thing that will impact home ownership in that complex, i.e. impacting the collateral for their loan. Okay, that's what it all comes down to. The condo is the collateral for the money that they're owing. So
Who
we're
pays
not,
for that questionnaire?
we don't, we send it to the HOA. The HOA, so there's a standard questionnaire. Some banks have their, but now it's standard. Now that every questionnaire is going to be the same. You might see a different logo at the top, but I promise you the questionnaire is the same because it's meeting standard Fannie Mae guidelines and or FHA guidelines. And it asks what it is asked. What is the percentage of owners? How many people are delinquent? What are your reserves? Do you have any special assessments? When was the last time you raised your HOA? When is the next time you plan on raising your HOA? If there's litigation, who did it involve? What is the status of the litigation? And so on and so on. And you can see that if I have to ask you 3 questions or 5, the likelihood that we're going to roll this baby forward is high. But if I got to ask you 35 questions, the chances that one of those questions become a problem or one of the answers becomes a problem now increases by the amount of questions that we're asking. So the limited review was a beautiful thing and it's gone. If you're currently in escrow on a condo that got a limited review, do not presume that the investor is going to fund it. You absolutely want to stop, halt, and ask the question because as of Monday, it's no longer eligible. And I believe the reason the limited review went away is because of SB 326 and the extraordinary amount of HOA associations who are tardy on getting the repairs done. Because that's what it is. They are tardy and they are late on getting the repairs even started. The bigger the complex, the more money it's going to take. So that one's going to be the biggest, the one that's going to impact everybody the most.
Mhm.
The master insurance updates. When you get insurance on a condo, the condo complex has to have its insurance and your HOA and the borrower has to have their walls in coverage. Some HOAs cover walls in. With this change that just happened, it's highly likely they will no longer accept a master policy to cover walls in, meaning you have the HOA has their insurance for exterior and everything outside of the unit, and walls in coverage covers the contents of the unit. And no borrower in Southern California should be buying a condominium without HO6 insurance. Like it's just prudent to have that insurance. Now the deductibles can go up to $50,000 a unit. So they'll let the deductibles go up to $50,000 a unit. But we just closed one where it was $50,000 a unit and the investor on a non-QM wanted the deductible to only be $25,000 a unit. And so they wrote a specific policy just for our unit. Not all insurance companies will do that. So the master insurance, that's kind of a biggie. That's where you want to make sure, we need to make sure there's really nothing for you guys to do. All of these items cost money for who's ever paying for it. So it's not just like calling the HO and say, hey, do me a favor. Can you fax me over a copy of your evidence? It doesn't work that way. They're like, absolutely. Pay the fee and then we'll send it over. So if the listing agent didn't ask for that, this is something we're going to discover during the financing. And the thing that's going to impact across the board almost every HOA now, and we're already seeing it, is the reserve requirement increase. Out of the 3 of these, while I think the limited review going away is like crappy, the reserve requirement impacts everyone. And the reserve requirement is 100% attached to 100% attached to the status of repairs in complexes. You're going from 10% reserves to 15% reserves. This is January 4th, 2027. So if you have a client who says, yeah, I want to put my condo on and the beginning of 2027, you might want to enroll them in listing that condo now, like legit. You might want to enroll them. The one that we had, quite frankly, it was miraculous that we funded it. I was sure we were not going to fund it because the condo had so many issues that hit every single one of these buckets. It was a master insurance issue, the questionnaire was an issue, and the reserve requirement was an issue. Why? Because the engineering report came back with $2 million worth of work, specifically $2.127 million worth of work to fix all of the balconies and stairs in all of the units. Where do you think the 2.127 million is going to come from?
Special assessment.
Exactly.
Yeah.
Or a special assessment and an
Yeah.
increase in HOA.
HOA.
Both. Because sometimes you in a complex like that, you can't just say, oh, we're doing a special assessment for $5,000.
Oh, she froze. So yes, it would come from the special assessments and
They never
also,
raise the fees.
Oh.
Everybody just writes a check because that's what they want to do. But if you're in Paramount or California, right, different demographic, and you go ask a borrower $5,000, you're probably going to be like, yeah, no, that's not going to happen. Break it down in a payment plan for me, right? So you're going to see fees going up for homeowners in condos. That is going to impact affordability. That is going to impact, it's going to impact everything, right?
How?
Saleability, all of that is going to be impacted by that. And right now, I think we have about, honestly, no exaggeration, 1 in 5 HOAs are funded.
Okay, you're freezing, Kim. Give her a second.
Of that, but the buyer's getting financing right now. So the bank is looking at it like, are they going to raise the HOA? Are they going to, you like, it's going to impact the affordability for the buyer. All of that's an impact. So all of it's a big deal, but the reserve requirement out of all of those negative changes is the worst.
Yep. So plan on it. HOA fees are gonna go up because the individual owners are gonna fund the extra 5% increase in reserves required. If there's not already a shortage, by the way. So the next slide, the next two slides speak to one another. So what makes a condo non-warrantable? Now we're gonna get into the specifics, the nitty-gritty of what a non-warrantable condo, or what makes a condo non-warrantable. So when people hear non-warrantable, they often think it means there's one major problem with the project. That's usually not the case, though. Almost every issue falls into one of these 5 categories here. So, and I'm just going to read a few of the headlines here. So, short-term rentals and condo hotels are a big one. So, who wants to own a unit when there's quite a bit of Airbnb rentals in the area, and you see have a lot of transient individuals coming in and partying on the weekend and leaving and coming back and partying on the weekend. So that will affect the condo financing as well. Now, the high investor concentration, this one right here just went away, so we X'd it out. Now, structural deficiencies and pending litigations, any lawsuits or certain structural deficiencies will affect the condo. Financial instability, excessive commercial space, and construction and control status. This is like the SB 326 we were discussing. So if you look at the financials, low reserves, high delinquencies, for example, and what we mean by delinquencies are the individuals paying their HOA dues in this market where inflation is high and eggs and milk are very expensive and gas prices are going up. People are in our skimping on, they're making their mortgage payment, but they might be not making their HOA payment, and and we're going to show you right now what it takes to get qualified and how much delinquencies are allowed. To finance a complex. Special assessments. So those are financial, legal, litigations, title defects, governing docs issue. Now, litigation doesn't mean that it's a deal killer. It just means that what type of litigation we're looking into, and we're going to get into that right now. What's allowable, what's not. Physical, critical repair, safety issues, deferred maintenance. Talking about the SB 326. Operational, we're talking about transient use, hotel use, Airbnb use right now. And last is insurance, insufficient coverage, high deductibles, and exclusions. So again, we're going to cover these in the next slides. Anything, Kim?
Nope. Plugging right
All right.
along.
Yeah, it's going along. Okay.
So the HOA questionnaire is the make or break document. And I think you got that from my ranting and raving about the limited review go away. But that's the document. And if you're taking a listing, have one with you, reach out to us, get the generic one, enroll your seller in spending the money up front. Consider that you're spending all your time possibly for nothing in the absence of this document. This is the one that tells us everything we need to know. Quite frankly, if we got nothing else and we got this document, we would be like 85% ahead. It's completed by the HOA or the authorized representative. It confirms the insurance, the budget, the reserves, the delinquencies, etc. It often triggers follow-up conditions from the lender, and I cannot tell you how many we get back of these with blanks or missing a critical answer. Probably 1 in 2 right now. Why? Because they have to answer like 30 questions, and there's a human being on the other end doing this, and they're charging this fee and they're pushing it through because everybody's in a rush. Bottom line, things get missed. And if we get it back and it was missing something, got to send it right back, especially if it's a critical question. Delayed or incomplete answers can jeopardize closing timelines. So if you're representing the buyer, it's your job Because your buyer, we just did one and the total HOA fees were like $1,098. So think about this. $1,098 to get the answers. Six
The questionnaire is $1,098, is she saying?
It varies in fees, but yeah, some HOAs are more expensive than others. It used to be like a $500 fee, but now we're seeing them upwards to $800 to $1,000 and change. So just know that the HOA questionnaire is where assumptions becomes facts, guys. So like Kim mentioned, one unanswered question can stop the underwriting completely. And sometimes the delay isn't caused by the buyer, it's caused by the HOA in getting that questionnaire fully completed. Because if one question is missing and they're not answering that one question, it can't stop the transaction completely. So we're going to move forward. Oh, I think we lost her. Okay. So what to request early? Okay, so notice the asterisk here. Now, these are the items to request. We're not going to go over it in detail, but we're going to get a copy of the presentation. And I know that some of you, like I know Kyle, for example, with the Serene team, utilizes this list right here to when he's writing up an offer with his clients. So you want to ask for the completed condo questionnaire. Now, typically, that's the one you're not going to have access to. That's the one you're going to have to really pay for. But all the other information right there, you can ask for. And usually that's available immediately from the HOA. So if you look at the HOA budget, the reserve study, the CCNRs, the litigation letter or attorney explanation if there's a litigation, for example, meeting minutes, HOA delinquency data, and so on and so forth. So the faster you see the documents, the faster we know whether this is a standard loan or a specialty loan.
Sorry about that. I popped out. My Wi-Fi went out.
Okay. So we just went over here the condo,
Okay.
what to expect early in the transaction. So basically, this is a list that you guys are going to hit the presentation, take a screenshot of it when you get it, and this is the items that you want to ask up front.
Cut and paste.
Cut and paste, literally cut and paste.
Exactly.
That's what Kyle did, right? On one of our transactions.
Uh-huh. And it's the smartest thing to do.
So financial red flags that can derail approval. So these are 3 financial red flags. Now we're getting to the financing health. So number 1 is HOA delinquency dues is a common agency red flag threshold to monitor. So remember we mentioned the gas of price, the gas of eggs, the price of milk, price of eggs is up. People are going to make their mortgage payment, but they may, hold off on making their HOA payment until, they have an income check coming or whatever the case may be. So this means that the individuals have not paid their monthly HOA dues. Now, 15% is the maximum delinquency allowed. Now, that number might seem big, it may not. So if you have a complex with unit complex with 100 units and 13 of those units are delinquent, then you're fine. But if your condo complex is 10 units and 2 of those are delinquent, then right there, it's a hard stop. Now becomes a non-warrantable condo. The upside about this one is that, and we've had this happen, where the seller who's selling this particular unit we may have a 10-unit property and 2 are delinquent, but one of those delinquencies, the HOA, the individual occupant there, the owner, maybe just like 2 months delinquent. We've had the seller cover that and bring it current. So then if you can do that and bring it current, then now that becomes a 10% delinquency and we can move forward. So there's a workaround around that, guys. Reserve funding expectations have historically focused on 10% newer updates. So this is the reserve requirement. So now it's 15%. It's going to be 50% in July, but right now it's 10%. It was before it was historically focused at 10%, but now start counting it and seeing that 15% because these HOAs know that this is coming and they're going to start prepping for that. But it's going to go into effect. What was it? 2027. Was it July 1st? I think.
January 4th.
January
January 4th, 2027. Yes. And so
And
this may be an opportunity for you as a realtor. Can you see that having this information, knowing this, I believe that HOA assessments and due increases could push somebody into a foreclosure or a default, depending to the extent, especially if somebody was paying $300 a month and now it's going to go to $600 a month. I can definitely see, but there's going to be a financial impact by these changes, and these will go away too in the future. But in a right now conversation, there is opportunity right now because HOAs are having to manage it right now. And this is when I think you can see people jump ship or buyers get extraordinary purchases.
Agreed. And special assessments can be okay or fatal depending on the purpose, status, or and borrower impact. So the special assessment is an additional fee charged by the HOA to cover expenses that aren't paid through the regular monthly HOA dues. So here's an example. If it's a $2,000 assessment for landscaping that's already been paid or being paid, that's very different than a $60,000 structural repair assessment that starts next month. So one's okay, one's green, one is in the red. And we've also seen this with it. We noticed that it doesn't matter how old the complex is, guys. Okay, so we finance, older condo projects with excellent reserves and no assessments that were easier than financing newer projects with weak finances. So age isn't a factor whatsoever when it comes to this. And just think of it this way, the assessment. So if it's a $30,000 assessment because everybody voted in to get new energy efficient windows and the entire complex, and it was voted in, and that's quite okay, as opposed to like a $3,000 assessment because there's rot with the balconies. So that'll be a deal killer. So it doesn't matter what the amount that of the assessment is. What matters is why the assessment is there.
Yes. So insurance has become one of the biggest condo challenges. Like single family residences, insurances aren't any different. It's just so that you guys know, California Fair Plan no longer insures condos, right? So if that's somebody's plan B, I'll just get California Fair Plan. No, you won't, not on a condo. So the master policy is what we're referring to because the whole complex has to be covered. All right. So making sure that they have adequate coverage and that it meets the requirements of the deductible and whether or not they include HO6, which is the walls in coverage that every borrower wants to have because it's covering their individual unit. Most conventional loans require the HOA policy, master policy to meet special coverage standards. What's a special coverage standard? Like a fidelity bond, right? In case the HOA president absconds with all the money. That was a big thing in the mid 2000s. That happened quite a bit. So the HOA has to be covered for that. Theft, injury, but like additional coverages that you don't need that on a single family residence, but on an HOA condo, you do. And then it requires perils and exclusions, ordinance or law coverage, flood and equipment coverage can matter. So not all two condo complexes are the same, like not all two cities are the same. Ask the questions. If something looks different than what you see across the board, ask the question, hey, does the master insurance policy cover this? And the deductible structure can create issues, especially per unit or named peril deductibles. Wind is one that we see come up a lot. Wind, fire, wind is the one that I've seen come up more recently that we never even really thought about. And my guess is that's probably around fires and fire hazard, right? Because they're kind of interconnected. So the most common challenge is that the HOA thinks it is insured, but the lender needs to be insured. And think about it this way. If you're going to loan your $500,000 to somebody, what kind of insurance do you want? You don't want California Fair Plan. You want to make sure you're going to get paid off in the event of a catastrophe. That's exactly where an HOA is coming, a bank is coming from. They want to get paid off. They're not looking at inheriting a condo complex. They want to get paid off. So the insurance is uber critical.
Oh, 100%. I was reading my notes here. So I think we missed. Okay, this was the one. So real quick, and reserve studies. So here's where you want to understand what how the reserves work. So usually workable routine capital planning. Where was it? So reserves are HOA savings accounts and future repairs. So just take a look at this one. Green flag, the green light routine capital planning assessment documents affordable current. But what is he? Kim, do you understand this one right here? I do understand it, but let me see my notes here.
Yes. So the reserve study is something that's saying what is going to happen in the future, right? So if you see us, I'll give you an exact example on the one we just funded. We got the SB 326 report, right? Or the one with Jeffrey. We got the SB 326 report and it alluded to things that could come in the future. So in them talking about things that are potentially coming in the future, it was a hard stop for the bank. Why? The first question was, how do we know they're not going to do a special assessment? How do we know? How do we know they're not going to do a special assessment? So if you see something on the reserve study that says next year we had planned that all the garage doors need to be replaced, right? In every unit, and you have 30 units, but there's no accounting for the actual line item as a cost, red flag. That's a red flag because how is it going to get paid for? Like our clients coming in with 3% down and seller pay close, they have no money at the end of this transaction. The underwriter can already see the type of borrower they are. So when you're looking at the reserve, many times a lot of our realtors, we've trained them to look at, is it 10%? And they're looking at the total cost of the HOA. Do we have 10% available? No, you have to look at the budget line items because it's telling you what is coming. The SB 326 report is telling you what is coming, and the budget, the reserve setting, the special assessments tells you whether the HOA has addressed it or not. And the one that we did on Workman Mill, the question was, and they emailed the HOA director directly, and they asked, in 2024, on December 18th, you said that all the work would be completed in 18 months. We are now July 2026. What is the plan? Where are you? And they responded, we're in phase two. Okay, that's not a response. We know you're in phase two, but there's 4 phases. 18 months later, you're only in phase number 2. How are the other 2? So they asked the question again, and the HOA responded exactly the same. And that was the deal killer because the bank is saying, if the HOA is not telling us what their plan is, then what they're telling us, they have no plan. They have no plan. And in the absence of a plan, we're not loaning money in there. So looking at the reserve, it's kind of like looking at your checkbook. You know you have to replace the roof next year, but you haven't been putting that $800 a month aside, and next year's coming. Now it's December and it's rainy season. How's the roof going to get replaced? It is
Yep,
exactly the same the premise, the reserve study and the special assessment analysis. When you
exactly.
see those
Items.
things, yeah, go ahead, JR.
No, I said, don't. Oh, go ahead. But as the items that are green light, for example, are usually like painting the buildings, new landscaping, repaving the parking lot, pool renovations, and upgrading the clubhouse. Now, yellow lights are more situations where we're not getting, like Kim mentioned, a clear understanding or information of what is needed. So answers like we don't know what the assessment's for, or we don't know who's paying for who's paying it, or we don't know if that work has already been completed, then we need more of a clarification, need more explanation. But red light items are structural repairs, balcony failures, SB 326 repairs, foundation issues, unsafe stairways, and like water intrusion, for example. And water intrusion seems to be a big one. We're seeing more and more.
Correct. Sorry, guys, my computer is about to run out of
Okay.
battery. My
And,
apologies.
okay. And we're
So
go ahead.
litigation, not all lawsuits are equal. Jay, I'm going to let you take this one because I'm not sure my system.
Okay, so all of the not all suits are not all lawsuits are
So
equal.
not all
So
lawsuits are created equal. We're going to let,
what are you talking?
and that's exactly it. It's just saying not all lawsuits are equal. And it distinguishes between the types of lawsuits. There's easier ones that you can get away with, like routine collection matters, slip and fall claims covered by insurance, anything that doesn't put the financial health of the HOA at risk. You're going to get past that. If it needs a review, it's an HOA lawsuit that says somebody tripped and fell, and it doesn't really give clear-cut answers. They're going to need more answers. And a high risk is when the entire HOA is being sued for like a critical injury. Somebody did fall, the HOA is maybe underfunded, doesn't have adequate reserve. That's a dead stop. It's highly unlikely that you're going to get that finance. So if you see litigation, you kind of want to figure out where it falls inside of these 3 categories, and then we pursue it from there.
Yeah, remember this is things that require a non-warrantable financing right here on the right side. So now let's get into FHA. FHA condo financing, approved projects or single unit approval. So with FHA financing, when you finance with FHA financing, the condo complex must be FHA approved. And there is a website, there's a place we can check and to determine whether the condo is FHA approved. You email us ahead of time, we'll look it up, we'll determine whether it is or not, we'll report back with the information. If the condo project is currently FHA approved and the approval has not expired yet, then that complex is eligible for FHA financing. And that's one way that you can get FHA financing in that particular condo complex. Now, if for some reason the FHA condo is not FHA, currently FHA approved, and I'm talking about the entire complex, you can go in for what they call a single unit approval, or the term we use, a spot approval. You might have heard us say it. You might have heard us speak of it on social media. And what this means is that you can actually go in for FHA approval on just your single unit in this entire complex. But know that if you go in for spot approval, because a lot of conversations we've had with clients, they seem to think, oh yeah, we can just go get in for a spot approval. Let's go in for a spot approval without even doing any of the homework. But the unit itself and the complex still has to meet every single FHA requirement. And we're going to go over that in the next slide in order to go in for an FHA spot approval. So it's not a guarantee that you're going to get it, but what we want to do up front is look at certain details that we have access to determine whether we're going to go in or not, because there's only a certain amount of units that can be FHA financed in a particular property. Now, if the complex has 500 units, we're not going to check title on every single one of those units and see what type of financing it has. But if we're dealing with a 10-unit property, we've been known to go in there and check title on each particular unit and determine what percentage are FHA approved. And so that's just like one hurdle that we get through to move forward to the next phase if we're going to entertain taking that on.
And just because a buyer got a spot approval when they bought it, doesn't mean when they sell it, they're going to get a spot approval. It absolutely doesn't mean that. So again, don't make that mistake. If your client has FHA financing, don't presume you can finance it FHA. You have to ask the questions.
100%. So these are the minimum requirements just to get FHA spot approval. So project size must be at least five units. What I mean that it's got to be a minimum of 5 units in the complex. If the complex has 3, 4 units, condo units, then it doesn't qualify. FHA concentration. The project with 10 or more units, no more than 10% can be FHA approved. So if you have a 100-unit complex and there's already 11 with FHA financing currently, then you cannot qualify for FHA spot approval. Owner occupancy, at least 50.01% of the units must be owner occupied in the complex. So you have a high investor concentration, it won't qualify for FHA spot approval. Delinquency dues, no more than 50% of the units can be 60 days or more delinquent in paying HOA dues. Commercial space, no more than 30%, 5% of the space can be commercial use for commercial use. And there's the reserve requirement. Right now, it's still 10%. So the HOA must have at least 10% reserves on hand at any given point. And that is literally, these are the big ones. And obviously, we look at other additional spot approval requirements like litigation. If so, what type of litigation is on there? Any special assessments, do they have sufficient insurance coverage, and so on and so forth. So you're gonna have access to this in the video as well when you're looking at that. So if you think you might have a client and they only qualify for FHA financing because they have a low FICO score and low down payment, and you're not getting that DU approval, then you want to start reaching out to the HOA and start asking these questions up front if you can get that information. Or you have a listing and you want to mark it as FHA spot approval eligible, then you will definitely want to know and make sure you meet all these requirements, right?
And VA financing, where it's different, is VA condo financing approval is VA specific. So the key points are the project should be checked against VA condo approval, obviously the first one. The project approval can be project specific and documentation heavy. Appraisal and condo approval requirements are VA specific, and the timeline can be a challenge if the project is not already approved. So caution for a realtor. Do not assume condo approved means VA approved. Ask the lender to verify before writing or accepting a VA condo offer if approval is needed. build the time into the contract, have a backup financing strategy available, especially if you're doing 100% financing, because 100% financing, as I mentioned earlier, on VA on a condo is not 100% financing on conventional. It is much more expensive on conventional. Veterans get extraordinary rates, as well they should, but this is a big difference. It will kill your deal if you have to flip them from VA to conventional.
And getting VA approval on a condo is much more difficult, guys, than FHA approval on the condo complex itself. So when a condo is non-warrantable, and this is where we're talking about the financing, what are the options? Well, these are the options. Portfolio lenders, like specific portfolio lenders, that's where we're right now with Jeffrey's clients. Non-QM, non-warrantable, non-QM lenders, those are ones that do special programs. They'll do full doc financing as well as profit and loss statement loans, the no income, no employment type of loan, bank statement sort of loans. DSCR investor loans, which also falls under non-QM type of financing. Bank statement, P&Ls, bridge or hard money. Obviously, hard money is doable, but you're going to have to come in with at least the 40% down to even utilize hard money type of financing, or cash or delayed financing. So ultimately, as you can see, these are non-traditional type of finance lenders or type of finance loans.
So it's not like your client or the buyer went and said, I went to Chase and they offered me like 5.5. And you're like, yeah, that's nice. That's not happening on a non-warrantable condo. Like it's literally that simple. So if you know you're dealing with one and you get a pre-approval, if you're the listing agent and you get a pre-approval letter from a traditional bank, that's your pause. That's your red flag. That's your hit hard stop. What other options are your borrower working for? Because saying it's an all cash deal is a huge disservice to the seller. The seller is going to be leaving money on the table unnecessarily so by eliminating a huge pool of buyers. There's enough buyers out there with big enough down payments for these investments. And again, they're extraordinary opportunities. So this is where you want to be upfront and say, okay, call my lender, right? We've had that a lot of times. They put us in the listing agreement and they're like, we want to know it can get done non-warrantable and we're not interested in messing around. We have extremely competitive pricing. Here's our lender.
We are the alternative to a cash buyer with this type of financing here. And so, cash buyer, after they get the first inspection, they start requesting
the things, the money, the credits.
money.
So how
Good.
So how non-warrantability can affect the buyer? Number one is the interest rate. That's the number one. Number two is the down payment. They may or may not need additional reserves where Fannie, we ran into you, didn't call for it. Now it calls, now the program, not the automated approval, now the program with the specific investor calls for it. Typically, you're going to see that to be 3 months. That's going to be a typical standard reserve. The costs are going to be higher. The timeline, I don't know that the timeline, I don't think the timeline is longer, but if we pivoted, like in our situation with Jeffrey, we had to pivot to a second lender because they couldn't get Fannie Mae financing, then we did end up needing a 10-day extension, which quite frankly was extraordinary that we were able to flip it and turn it in 10 days. And they need to have an exit strategy if they're doing something like hard money. Okay. If the property can't get financed today on regular conventional financing, and investors going in and taking hard money, they're typically not going to hold that paper for more than 12 months to 24 months because it's expensive. So you as their realtor, what's their exit strategy? What is it? If we do a non-warrantable condo, right? So two exact scenarios. Jeffrey's clients and the Mayas, who are another realtor's client. They're the ones who bought in Workman Mill. Those units will not be finished for 2 more years. So they are not getting regular conventional financing in 2 more years. They're not. It's not until that's done because the guidelines would more likely become more restrictive than more favorable. So we had to tell them, you got to be cool with this loan. Like, don't come back in 6 months and say, I want to refinance. I found a lower rate, because we're going to go through all of this pain again. The HOA will not have managed their challenges within 6 months. In Jeffrey's buyer's instance, that HOA complex should be finished to the T probably in 4 months, which means in 6 months, right? Because we have a 6-month turn time. In 6 months, they're going to be able to refinance into lower financing. It's important for a buyer to understand that. How long are they going to be with this financing? Because they're going to see a television commercial saying rates came down and they're going to want that lower rate. And if nobody explained it to them that, hey, the HOA is not going to have this done for 18 months or 2 years, imagine the buyer being super disappointed when he can't get the lower rate because he's in a complex that still is managing its health and safety issues. So the exit strategy, explaining it to them to have one, is very important.
Just preparing for the future. Maybe not so distant future, but the future, their outcome. Yeah, in this case, we already know the outcome. That's with no delays. So where the condo deals usually get stuck, this is more of a visual just to explain to you guys where the offer gets accepted, docs are ordered, which means that we get the docs from the HOA. It goes into underwriting, the insurance is reviewed. Now, if there's an issue and it becomes an unwarrantable condo, usually right around here is where it gets denied, declined, or it gets stopped, it's suspended. And if we go to a traditional lender initially, that's where the timeline, we talk about longer timelines, then we have to revert back to a new lender and start here newly again with the other lender and push it through. If we know this information up front, then we can kind of push it through here one time and not have a delay in the middle of the transaction whatsoever.
And so this is why condos cost more to finance. Okay, so a single family home, $700,000 standard purchase price, standard loan pricing, no HOA dues, lower financing costs, lower monthly payment. SFR is the way to go. Condo, $700,000 purchase price. There's already a Fannie Mae built-in hit. It's called the loan level price adjustment, or an LLPA. That is a Fannie Mae pricing hit, not a bank pricing hit. So right out the gate, you're paying more because it's a condo. Then you have the HOA dues, higher financing costs, higher monthly payment. Why? Condominiums with less than 25% down typically receive an additional 0.75% Fannie Mae loan level price adjustment. So across the board, it's almost 1 point higher in cost, half a point in rate, 1 point and higher cost in rate, unless you have a very high FICO borrower with a very good down payment, meaning 20% or more. When you combine these with the HOA dues, buyers often end up with a higher interest rate and a higher monthly payment, very similar to if they bought a house. So the takeaway here is a lower purchase price doesn't always mean a lower monthly payment. Alternatively, compare a single family residence or duplex before deciding on a condo. So when a buyer says, I want a condo, it's typically because they saw the Zillow listing and that condo said the price was $550. And in their neighborhood, the houses are going for $800,000, right? That's typically what it is. But if you throw in a higher rate, same insurance, sometimes higher insurance, HOA dues, then you might not be at an $800,000 payment, but if you could go FHA, you probably will be comparable, even though the difference, the gap is 200 grand. So the point being is, this is where you're educating the client. And a duplex is when somebody says, I don't want to be a landlord. Well, if you're buying a condo, you're owning it with 100 other people. So no, you're not a landlord, but you sure don't live by yourself. Does that make sense? It's like living in an apartment building. So educating a client on these, allowing them to make choices that suit their lifestyle and their financial game for their future, right? Not everybody wants to land up in the same place. A condo complex can be a perfect place to start and flip it into a rental. But if you come in with 3% down on a condo and you have an HOA due and your mortgage insurance is like 1.17% because your FICO is below 700, you're never going to rent that baby out for the mortgage payment. We just financed a client who bought a condo in Mission Viejo. His mortgage payment is $4,200. The market rent is $2,800. The gap is huge. When he bought that condo, he had no idea he was going to get engaged. Got engaged, now he's buying something else, and now he's negative on the condo. But it's all he can do to get out. So helping a buyer, a client see those things through is extremely important for them.
100%. So yeah, and just to give you guys an idea what this 0.75 means is that for the same rate, there's a 3/4 price hit, which makes that same exact rate 0.75% to the loan amount more expensive. Or you can offset it by increasing the rate, and so you'll have a higher rate with the same pricing, like cost for that rate or par pricing versus a single family residence at a lower rate. So red flags to look for in the listing. So if you see any of these, it's probably a non-warrantable condo. So you want to tread cautiously and ask the right questions, the questions we're proposing here. Investor friendly, very high HOA dues are usually, special assessments, litigations. Typically, you're not going to see any realtors list with any information like litigation or lawsuit pending, but you're going to see cash only or cash preferred.
And so questions you should ask before you're writing an offer. First thing is the project warrantable or have lenders had any issues? That's the first question. Is there active or pending litigation? Are there any special assessments now or planned? Any major repairs, inspections, balcony, roof, etc.? Is the HOA master policy current and adequate? Can the HOA management company complete a lender questionnaire quickly? Is the project FHA or VA approved? And are there any short-term rental, condo hotels, or commercial use concerns? All of these, you can literally cut and paste these before you write the offer. The big one, I think, is can the HOA management company complete a lender questionnaire quickly? Why is that a big one? Because if you're writing competitive timelines, like 5 days or 7 days, which we can meet, the approval is not worth the paper it's written on in the absence of the lender condo questionnaire. Some, believe it or not, some HOAs only take checks. They do not take credit cards. We just closed one in the Valley. They don't take credit cards. So if you have to mail a check before you get the doc, how are you going to drop contingencies in 10 days when you're barely getting the condo docs 8 days into the transaction? So when you're writing an offer or representing a client and or accepting an offer for your listing agent and they give you short timelines, you might want to know the answers to those questions because it's going to make a difference.
100%. And real case studies, real world condo challenges and how to think through them through. So balcony repairs, need, repair scope, funding source, completion status, engineering. So in other words, you're looking for red flags. Are any balcony repairs, insurance deductible issues, litigations disclosed, HOA not responding. HOA not responding is a big one, guys. That's actually a most common one right now that arise when we're in a transaction on a condo transaction. Investor heavy project, short-term rental project. So anything on this one, Kim?
No, I just want to say we literally had an HOA flat out tell us no. Nope, that doesn't belong to your unit. Nope, we're not giving you what you need. Nope, they had an attorney call the sellers. I mean, it was insane. I've never had that, but just had it happen in Mission Viejo. Again, had 3 condos in Mission Viejo, and one of them had wood, one of them had SB 326. The underwriter wanted to make sure that the repairs were done on the other units just because it was on the minutes. Okay, it was on the HOA minutes and they would not give us root. And they're like, nope, doesn't belong to you. All the screaming in the world had to flip the borrower into a non-warrantable product for only that reason, because the HOA would not answer the question. So, just it's something to be like, what are you going to do? It's kind of
Yeah.
like the mafia. They're holding everything. What are you going to do? It's just like you got to deal with them.
Yeah, the takeaway here is that it's no longer the escrow officer, title officer, realtor, and lender in the transaction anymore. It's also the HOA. Now you maybe have an attorney and you're waiting on the attorney. You have the insurance company, you're waiting for them. So there's a lot more people that we're in bed with in every transaction when it comes to condo. There's more hands in the cookie jar here.
I also want to say this for the listing agent, get your seller involved. Like, get your seller involved. In the transaction we were involved that we are involved with Jeffrey, I reached out to this listing agent, God bless her heart, super nice, at half a dozen times. And when it finally hit her that this is not about the borrower, it's about the complex, for crying out loud, she gets her seller involved, and in 3 hours, we get the answers we couldn't get in 3 weeks. That this is not the place to be the hero. Your seller's paying an HOA company a fee to manage their complex. They are entitled to answers. And a huffy seller gets much more response than a loan officer begging for the answers. So get the seller involved very early on. It saves so much pain.
We need to add happy seller here. That's a good one, Kim. Thank you. And last slide here. The action plan, the 10-minute condo pre-screening. Take it away, Kim.
So this is what this literally, if you do nothing else, just cut and paste and leave this on your desktop. I'm showing a condo today. This is what I should be asking. I'm listing a condo. I'm going on the listing presentation. This is what I should be asking. I'm going to go write up an offer today. These are the answers I should have, right? So you want to ask all of this at a minimum. This is your bare minimum 10-minute condo pre-screen. Memorize it, cut and paste it, have it on the desktop. Uber critical to freedom and ease in your transaction. Literally, uber critical to freedom and ease. Because having these answers at the cuff, and Jeffrey can, I'm using this example so much because these are all real world experiences that are literally unfolding in real time. We've had dozens of them this year, but he asked all the questions. And I told him, it was in around January. This buyer he'd been looking for a minute. I think it was around February or March. We did our initial pre-approval. And so when they found this one, they loved it. Jeffrey asked the listing agent, and I told Jeffrey, it says Fannie Mae said it expired in December 2025, their approval. The listing agent, because she sold a unit, this unit, to her seller in June of 2025, she insisted with Jeffrey that everything was fine, that everything was fine. And I can understand her reasoning because in June of 2025, everything was fine. Everything was fine in June. But in June of 2026, it was not fine, right? And so this is where you see the gap in understanding the difference between fine and not fine. And I promise you that for everybody who's on this Zoom today, you know more than 85% of the people out there either buying, listing, or selling condominiums. And so you can, with this presentation, market yourself as an expert. And why should you? I don't know, Jared, do you want to share our 3 most recent, well, just this month? And when I say recent, I'm talking 4 weeks old, just the opportunities that the buyers have stepped into?
Absolutely, Kim. In fact, let me pull this up because I have it right here on our social media page. But these are 3 transactions that we've closed one of them being the one in Whittier with the, it looks like a forest. And by the way, full disclosure, my first condo complex, my first property that I purchased, I lived in Whittier. I purchased this entire complex, and you feel like you're in Big Bear. The only thing missing is the snow, and it's completely woodsy and it's very nice. It's got streams running through it, very tranquil, but it is old and it is a lot of dry rot, a lot
Hazard.
yeah, a lot of dry rot. So there was this particular property here. Let me just share screen. I'm going to share this real quick with you guys. Here's the visual.
And this is the why right now. This is the why for a buyer or a seller, in my opinion.
This is the Whittier property we closed on. This is the one where the 2 agents are like, SB 326, what is that? So the buyer purchased the property for 485,000, right? Under market,
Yes.
clearly because of the issues that are arising. But to the buyer's benefit, even taking this alternative financing wasn't far off. It was still full doc financing with a non-QM lender. The appraised value came in at 535. And guys, that is what the appraiser brought it in with $485,000 in front of them. Maybe the property is worth more. Appraisers are gonna only push it so far unless you're asking them for a value check and see if the property actually appraises for more. This individual closed and purchased into $50,000 in equity right off the bat. Now, we have this one right here, which is Jeffrey's client, and the purchase price is $685,000, and the appraisal came in at $735,000, right? So it's already,
Yeah.
we're gonna be closing that one soon, and that one is the client's gonna walk into $50,000 of equity right off the bat. Now check this one out in Toluca Lake. This borrower is purchasing at a purchase price of $1,095,000. And you can see the property appraised $175,000 above purchase price. So this is the opportunity that are created right now with condos, because condos are being priced so moderately, and are actually priced under market because of the issues that are arising with these condos. And all 3 of these, by the way, all 3 of these condos have some sort of issue with the property.
Exactly. And this is, I can specifically speak to with a huge degree of certainty. On the Workman Mill, it's exactly why the buyer took the higher rate and that program, because they walked into equity. In Jeffrey's situation, it was the turning point for the buyer. It made it impossible for the buyer to say no, even though he was taking a 0.5% higher. Why? Because these are temporary challenges for associations. And I really want you guys to get that. And not one of these appraisals was influenced. And what I mean by that is we didn't reach out for a value check. We didn't ask if the value was going to come in. We didn't ask anybody, can we push? Nothing. These are 100% neutral appraisals with zero request for anything. And I really want you to wrap your head around that, because like JR said, it is rare, extremely rare, to get an appraiser to give you more value than you need.
On a
And
purchase.
in the month of July, this recent, 3 out of 3. And I had a theory. We were tossing it around on our team meeting, and I said, I think there's I go, if I'm buying right now, I want to buy a condo and I want to negotiate the hell out of that condo. And I'm going to pay attention to when the work is going to be done and if there's a special assessment or not. Because if I'm walking into equity right now, imagine when the condo complex has everything together and fixed up. Then I just had a grip of equity. How many SFRs are people walking into equity? None. I haven't had an SFR appraise over the purchase price since COVID, I think. Like, it's been a long, long time. But in condos, to me, when you see a pattern in real time with zero request or influence, you couldn't get a more neutral appraisal. And people are making money in real time. If you have 20% down or more and you're going to buy something, you're going to have almost zero competition on the condo market. You're going to get your clothes. You're going to get everything. Our clients are getting everything that they want, right? They're getting everything, or they're getting the time. Nobody was threatening to cancel on any of them. In fact, when they realized that their HOA was the challenge, they were like, oh, thank God. Like, thank God we have an offer. Like, everybody's cooperative is my point. Everyone is cooperative, because us as the lenders tell them, do you really want to go out there and start all over again when the property's been on the market now 60 days and it's a condo and the HOA still hasn't done any of this? No, what seller would want to? Legit, what seller would want to? So if I'm looking for opportunity inside of listings or transactions, I would absolutely be looking at condo complexes. If I'm looking for an investor, I would share this with an investor and say, hey, there's real opportunity right now. And it is a timed conversation, because when all of these are fixed, the opportunity will be gone. When all of these issues are fixed, the opportunity will be gone. And so I think the next 12 to 24 months is going to be an extraordinary time. And we keep getting, we subscribe to a housing report, and we literally got something, a whole newsletter last night. And I sent it to JR and I'm like, look, we're 100% accurate on calling this trend, on calling this pattern. So you want to be a leader in the industry, or you want to be somebody who's going to matter and make a difference, then bring this information to the market, because people are still talking about houses and all of that's great. But the real opportunity, I haven't seen opportunity in the condo market like this since probably the housing crash. And so for those, every one of our buyers right here, they made extraordinary purchases with very, very good financing. Sure, it was like 3/8 higher, or a 0.5% higher. One of our clients ended up getting $10,000 closing costs when they had nothing, just to stay in the transaction. So that is what's unfolding you right now. And that's where you want to be keeping your eye out. Like, don't be afraid of condos. Come equipped with the information and the questions. And just right there, you're going to distinguish yourself between yourself and every other realtor representing a buyer in in this category.
And like Jeffrey, come with thick skin. You're gonna need it, right, Jeffrey?
And I
So
told him, I was like, we're gonna close it. Like, don't get like, we are closing this. And they
yeah.
friggin' signed docs last night.
Mhm. So questions, okay, so Albina had one. So for the inspections in the financing focus, for the inspections, is the financing focus on the inspection of the unit in construction and consideration for sale, or the condominium in totality?
Both. That's a great question.
Mhm.
And in a non-warrantable, just so that you know, how do we get the financing when it's not warrantable? Because we work with several investors, but one of the best investors that we work with that has really good pricing, where we're closing Nguyen and where we closed Maya, is that they will look first at your unit. So if your unit is solid, we're gonna go into step two. If your unit is not solid, we will more than likely not go into step two without the engineer and or contractor confirming it is safe for someone to live there, and this is when the repairs will be done. If we get that letter, then we can move forward with both the unit and the complex. In the Workman Mill situation, when they're 2 years away from finish, like this loan, just so that you know who finances, the bank is the investor that we go to, but it's financed by a hedge fund. So these are the pools of billions and billions of dollars.
Mhm.
And we were at CTC waiting for the hedge fund approval, and they called me up on Tuesday night and said, we are 99.9% sure the hedge fund is not going to approve this because the HOA simply will not respond on when they're going to finish this. And at the end of the transaction, I was so concerned about basically devastating my buyers who are first time buyers, go figure, whose dad is giving them the money to buy the house. And lo and behold, all the forces came together, the extraordinary relationship we have with this bank and Equity Smart has with this bank. They text me on Wednesday morning, 2 minutes before I'm ready to call out the bad news. The hedge fund approved it. And I was just like, I couldn't believe it. Like I literally couldn't believe it. So those this happens all of the time,
Acceptance.
but that complex where our unit was good, Elvina, our unit was like immaculate. The complex literally had balconies with red ribbon, red tape across them. And that normally would have been a deal killer. I'm still stunned that our investor went for it, but they did. So it's a case by case scenario and really how bad the work is. And if it had been a bigger down payment, it probably would have been easier for the investor to get to a yes faster, because the more skin in the game, the more shared risk there is, the better an investor feels.
Yep. Good question. I think you answered the second one. Yeah, it's both as well.
Mhm.
And any other questions? Can I get a copy of this? Yeah, we're gonna send you guys a copy of this. We're gonna download it and send another email to you guys, the presentation.
So we're going to send it out. We're going to post it on our YouTube. So if you're working with a seller or a buyer and you just feel like this is great and it's way too much for me to say, send them to our YouTube channel, right? Send them to our YouTube channel where they could, because as whoever you are in the transaction, it's as critical, this information, to everybody in the transaction. And if you're looking at a listing or you're showing a property, just like send me the address, send JR and I the address, send us the HOA, send us the MLS link, and we'll find out for you. Is it FHA approved, or is it Fannie Mae approved, or is it Freddie Mac approved? Like what approval it is. You want to start there first. Don't have somebody go fall in love with the unit. Let's start first saying, hey, can we get money to finance this unit, and what kind of money can we get?
Real quick, we have a list. No, we don't have a listing. We have a realtor who has a listing in, what is it, Downey, I think, Paramount, something like that. Yeah,
Paramount.
Paramount, right? And she held the open house. She listed it, held the open house, got a buyer for the open house, a possible buyer, sends them to us. We're doing the pre-qualification. In the pre-qualification, we look at she wants to qualify. They're interested in this particular complex. We, do our due diligence. Let me just check to see if it's FHA approved. But lo and behold, the whole complex is FHA approved. This agent who's listing it didn't even know it's sitting on a gold mine. You have an FHA approved condo, you're going to mark it as an FHA approved condo in bold letters. So again, if you don't know, reach out. We'll find out.
Exactly. Don't go blind. There's no need, right? That as partners, this is what we're here for. And if it's speaking to a first-time investor, I swear to you, if I was a first-time investor, I would legit be looking at condos right now. I would
Yep.
absolutely be looking at condos. You got to have 20% down either way, right? If you're going to make an investment, I would start with condos first. Condos in a great area. That's exactly where I would be location, 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 and look for the opportunity inside of that condo complex. I promise you, like I'm that certain that you will find one.
Yep. So I'll take a look at that listing, Frederick. He asked if his listing was FHA approved. I'll email you back with the results.
And if you have an FHA approved listing, that's going to take you to sold so much faster than a listing that's just that you can't get FHA approval. So if you have an FHA approved listing, you market that like that 3.5% down payment is a big deal. And it's a difference of sometimes like a full percent in interest rate for a buyer. So it's like how we say pan caliente, like hot bread, baby, right out of the bakery. So you work it because there's value there.
Exactly. Any last questions, guys? All right.
Okay, great. Well, thank you guys so much for joining us. We really appreciate you being here. I hope this was informative. This is the first of many. JR are going to do this regularly. We're looking to do it on a monthly basis, just educating whoever wants to hear something new. JR, what are we going to be going into detail about in our next one, just to give them a little taste?
The tax, God, my brain right now, it's the, what is it called?
The cost segregation
Cost
analysis.
segregation analysis. I should know, we put this damn, this presentation together, went over the whole thing, right? But, yes, the tax segregation,
The
cost
cost
segregation
segregation analysis. We're going to be doing
analysis.
that one next. If you have an investor who's looking to buy, is on the fence, if you have somebody who already owns and you want to provide value to them because you sold them an investment property in the last 5 years, if you just need to know more about it yourself, which I promise you all do, join us. You'll see the links come up. That'll be a good one. It's very detailed, right? So, but very specific. And yeah, we're looking to provide great, valuable information for you guys on your
Yes,
lunchtime.
and I know
So
this
very
one,
long lunch and learn.
yeah, this one went long, but thank you guys for tuning in. If you guys are willing to put into work, we're putting into work as well. So thank you guys for
Exactly. So
for
thank you guys. Have a
sticking it
great
out.
week. And remember, your financing team, your condo experts, your all thing mortgages. Kim and JR, we're here for you.
We're here.
Thank you, guys.
Have a great day, guys.
Bye,
Bye.
guys.